There's no specific amount of years. But because this is a time value of money concept, right? You're going to get these deductions, the same amount, whether you use it, the regular IRS prescribed, you're getting the same amount. But we want to make sure it makes sense.
Welcome everyone to another section of Ask the Multifamily Expert. Today I have with me a very interesting and a very big expert in the industry of multifamily. Before I go to him, I would like to tell us a little bit about the purpose of Ask the Multifamily Expert. The reason why we started the Ask the Multifamily Expert is to give people the opportunity to have direct access to experts, ask their questions, and continue on their journey. It's very important that you have access to these people in order to get your questions answered and you'll be able to further more in your journey. And today we'll be discussing a little more about cost segregation. The very interesting thing about cost segregation is I have benefited from it for a long while now, but not until last year I benefited way more than my expectation. Last year I got K1s in millions, so I was really happy about it. And that is the beautiful thing about cost segregation. If you do things right, you get the right cost segregation company to perform the study and also get the right CPA, you'll be surprised how you will not be able to pay taxes if you do things right. So this is one of the reasons why we decided to bring on an industry expert to tell us a little more about what cost segregation is and how you can take advantage of it in writing off your tax liabilities. This is not just for multifamily. You can use your K1s to write off passive liabilities as well. So we'll be asking him different questions, and you also have the opportunity to ask him questions. You can either raise your hand or you put your questions in the Q&A section at the section below. So if you want to ask questions directly to our guests, you can signal us or let us know. We'll elevate you to the section where you'll be able to ask your questions. There's a raise your hand button below. You can click on it and we'll call you. Or if you're shy, you don't want us to see your beautiful face, then you can go to the Q&A and just put in your questions. We'll try as much as possible to answer as many questions as possible. We're going to go right into the event. I have with me the CEO of Madison Spec. Madison Spec is one of the biggest, in short, let me just say the biggest industry in cost segregation, and they are professional in what they do and all that. I currently engage their services for my deals as well, so I know that they'll be beneficial to you. And there's no other better person to tell us much more about cost segregation than Ellie. Ellie, I don't want to mispronounce your last name, so I'll give you the opportunity to give us a summary of who you are. Tell us your profile, what you do, how did you get to being in a Madison Spec and all that.
Thank you, BB, and thank you to everybody at Blue Ocean who was involved in making this webinar happen. My name is Eli Lobenberg. I'm a CPA. I live in New York, though full disclosure, I'm actually away on vacation with my family, so I apologize if you see people walking back and forth behind me. I'm near a boardwalk where my family's at the beach. I was just trying to set up a place, but my original place that I was going to do the seminar was underground and the reception was terrible. So I apologize if there's any ambient noise or people walking back and forth. BB, obviously, if for any point of the conversation I need to speak up, just let me know and I'll do so. So again, it's Eli Lobenberg. I'm the CEO of Madison Specs, LLC, which we are focused on providing quality cost segregation studies for our clients. I've been doing this for close to 30 years now. I started my career with Deloitte & Touche in New York City. From there, I was a senior tax manager in KPMG's national tax practice. And then in 2004, I was hired by Grant Thornton to run the Northeast region's cost segregation practice for them. So I learned the business from the guys that really created the business of cost segregation, the Big Four, back in the mid-90s. And I used my experience, and in 2006, I partnered up with Madison Commercial Real Estate Services, which is a full-service real estate services shop, which includes a title agency, my company, which is a cost segregation company, a 1031 exchange company, Madison Exchange, where they were a qualified intermediary. We'll touch maybe a little bit on 1031 exchanges, but that's a sister company. Then we have another company that provides lease abstracts. And finally, in tandem with the lease abstracts, there's a company that provides pre-acquisition financial due diligence. So if you're looking to buy a property and you're given a bunch of numbers from the seller and a purported NOI on the property, if you give that to the real diligence folks, they'll scrub every income item, every expense item, and they'll come up with the true NOI. And if it's substantially or if it's lower than what the seller says, it may be a point that they can renegotiate the price. So those are the companies that my company serves underneath the overall umbrella of Madison Commercial Real Estate Services, where our goal is to service the entire life cycle of a real estate transaction. As BB mentioned earlier, BB's been a wonderful client of ours. We service clients all over the country, small, medium, and humongous. When I say humongous, if you Googled the top 10 largest commercial real estate transactions in the country over the last 4 years, Madison Specs has serviced 5 of them, half of them. So thank God we have a robust practice. We're very excited to work with all of our clients. We give every client, small, medium, or large, the focus that they need, the attention that they need. And most importantly, we hold the CPA's hands all the way till the end of the study so that we make sure that everything gets booked properly. With that, I guess, BB, should we start?
Yes, so I'm going to start asking you some questions before the audience starts warming up. And first of all, what's cost segregation? Because we've been hearing a lot about cost segregation, but I know some people don't really understand what it is.
Sure. So cost segregation is a tax and engineering analysis of all real property, where your goal is to be able to reclassify assets from longer depreciable lives to shorter depreciable lives, thereby getting a larger deduction up front. This larger deduction will offset any taxable income that the client will have, and that in turn will lower the taxes that they owe to the Fed and state and city authorities.
Okay, so let's break it down a little more for some of us that are novice in this. Okay, assuming I have a property, so is this for any property like single family, or is it just for multifamily? What properties enjoys the benefits of cost segregation the most?
Great question, Vivi. The answer is it's for all properties. And depending on the type of property, that will determine what the overall benefit range or the benefit amount is going to fall out. So let's talk, we do properties and anything from single family rentals to multifamily garden apartment complexes. We do offices and shopping centers. We do nursing homes and assisted living facilities. We do manufacturing, industrial, and warehouse. We do doctor's offices. We do automobile dealerships. We do car washes. We do gas stations. We do mobile home parks. I probably left a few out, but that probably covers 90 to 95% of the property types. And as I said earlier, depending on the type of property, you will get a certain amount of a reclass, which some will be a lot higher and some will be a lot lower, depending on the uniqueness of the property and the specialization of whatever assets are in or on site at the property.
There's a misconception out there that we hear that it's not beneficial to single family. I don't know if you've heard about it, because I know many single family operators that have not taken advantage of cost segregation, either because they do not know what it is or because there's a misconception going out there that you can do this for single family and all that. So my question to you is, do you know about the misconception, and what are things that you guys can do to start educating people more that it's for every property?
Great question. So I think the answer is that single family rentals are great studies. We literally do thousands of them every single year. And I think the misconception is twofold. It used to be back when we first started doing cost segregation studies, I'm going to take you back to, the late 90s, early 2000s, we were really only doing it for the large companies, the Fortune 100s of the world. So we sort of wanted to make sure that there'd be enough benefit meaning the net present value benefit of whatever deductions that we were going to accelerate would obviously way more than exceed any cost of the study. At that time, to be honest, a single family rental, a property that maybe a client bought for $100,000 or $200,000 was challenging in that we wouldn't be able to deliver enough of a value proposition to the client. So I would say in the early years, we didn't do a lot of those, if any. But I think today things are different. I think, BB, we're finding more and more younger investors that are going into single family rentals to run the properties and also to be able to benefit from the to be able to get enough tax benefits from the property. And I think that now the younger groups are more sophisticated. They're talking to their accountants. They're learning about things like real estate professional status and the ability to be able to offset. Do I have active income? Do I have passive income? What could I use? What could I not use? What are some inherent limitations that I may face? So all those things, fast forward to today, in 2024, we're seeing more and more educated professionals that are invested in real estate who need the benefits, who want the benefits. And our goal at Madison Specs is to inform and educate so that the client or the prospect has enough information that they can make an educated and informed decision whether it makes enough sense or not to do it.
One very interesting question I have is, cost depreciation, after doing the entire process and we give out K1s, we always find out that in year 2, year 3, the K1s are usually very small. So the question I have for you is, really, what is cost segregation? I know you've said it. What things are we depreciating or is accelerating? Which of those items? Because I know that I'm not a CPA, but I know that when you have a property, it's broken down into 4 areas. The land, personal belongings, and all that is broken down. Can you just break it down and tell us exactly which of those items are accelerated and why does it reduce as the year goes back?
Sure. Absolutely. Great question. Okay, so let's throw an example out there, okay? Let's say you bought an apartment building, okay? So without cost segregation, and I'm going to make the numbers real simple so that the example will stand clearer. Let's say that you paid net of land $27.5 million for this apartment complex. Okay, so without cost segregation, you'd give the settlement statement to your accountant, and he would take that $27.5 million and he would depreciate it as residential rental, which is 27.5-year depreciation, which means that you would get a deduction for depreciation of $1 million a year for 27.5 years. That means if you don't put a nickel into the property, by year 28, you've fully depreciated the property, okay? Cost segregation says, let's do the following. The property is on a piece of land. All the improvements that surround the apartment property. Now, that would include stormwater catch basins, site landscaping, site lighting, sidewalks, pavement, fencing, etc. Anything that's on the property line around the building, that's something called Section 1250 land improvements. And those land improvements, the IRS allows you to depreciate over 15 years on an accelerated basis, what we refer to as MACRS, which is modified accelerated cost recovery, okay? So those are the assets. So now, right? So we started off without cost segregation. Everything is going to be sitting as 27.5 year, besides obviously the land which has it's non-depreciable. Then we're going to go into the building itself, okay? Now in the units itself or in the common areas on the various floors, certain types of flooring, millwork, decorative items, certain cabinets, kitchen appliances, window treatments. Those are assets that are called Section 1245 tangible personal property. And those assets get depreciated over 5 years on an accelerated basis. So at the end of the day, going back to our example, right, instead of getting that $1 million deduction each year for 27.5 years, with a cost segregation study done, you may get 7 to 10 million over those initial years. And obviously, the client who can use those deductions will be able to offset their taxable income by those deductions.
Thank you for explaining it better. So, assuming I bought a property in 2020 and I did not take advantage of the cost segregation's benefit at that time, and for some reasons I listened to you today and I said, oh, I've owned this property for 5 years and I've not done my cost segregation. Can I go back and do the cost segregation and catch up on the past benefits?
Great question. So the answer is that cost segregation studies can be done prospectively, new construction, new acquisition, new renovations, and they also work retroactively. So we can do a study and go back in time to the time that you first placed the asset in service, and we're going to do the study and catch it up onto your current tax return. We do that by filing what's called the change in accounting method. It's an IRS Form 3115. It's an automatic method change, which means it does not need IRS commissioner consent. It's granted simply by the accountant attaching it to the timely filed tax return, including extension. So at the end of the day, to answer your question, is you can go back in time and get it on your current return, which you do not have to amend. And I think that's very important for anybody out there who deals very closely, works with their CPAs on their properties. CPAs are very, very, very gun shy and don't want to amend tax returns because they believe that amending a tax return will increase somewhat of an audit risk vis-a-vis the IRS. The truth be told, there is some increased risk. I'm not going to lie to you if you were the amended return, because the amended returns usually trigger in the IRS computer, the way their algorithms work, it usually triggers something. But just to put you at ease and your investors at ease, a proper cost segregation study should stand the scrutiny of any IRS audits. And you may be leading into a question about IRS audits. I could see by your face, Bibi. But the answer is that the look-back study can be done, and it's done on the current income tax return. We get the catch-up adjustment, and all that missed benefit from those missed years, you get it on the current return.
The reason I'm asking you, because this is a personal question for me. I got to know cost segregation pretty late in my multifamily journey, and we had about 50 single families before we transited into multifamily. So the entire single family, we didn't do cost segregation on them. We sold some we still have, and all that. So for the multifamilies we bought earlier on, no cost segregation was done on it. And for some reasons, we called our tax personnel and we said, okay, we're going to do tax segregation on these properties. Can we go back and catch up? And he was just like, we don't want the IRS to audit us. You know what? Let's give it for the future and all that. So that's why this question, I had to bring it to you to see what your perspective is. So to understand what you said, we can actually go back in time, do the cost segregation, and use it for those years. So let's say I went back to do for 2020, 2021, 2022. So what you're saying is I can take that study and go back to my 2020, 2021, 2022 and use it to depreciate my tax liabilities. Is that correct?
But it's going to be on your current return. So we'll go back to properties that you bought in 2020, 21, 2022, and 2023. Let's assume you've already filed all your 2023 returns, whether you did it or not. Doesn't matter. We'll assume you did. So for 2024, we're going to get those catch-up, that missed depreciation on your 2024 return. So for your 2020 acquisitions, we'll get 4 years of missed depreciation accelerated for 2021, 3 years, etc. The only thing to keep in mind, Bibi, and everybody on this presentation, is we want to make sure that the property has enough depreciable basis and is young enough so that it makes sense to do. So typically clients say, Eli, how many years can we go back? So statutorily, there's no rule. There's no specific amount of years. But because this is a time value of money concept, right? You're going to get these deductions the same amount, whether you use it the regular IRS prescribed way, 27.5 or 39-year for commercial, or whether you get bits and chunks up front with a cost segregation study. You're getting the same amount, but we want to make sure it makes sense. So like it could be, Bibi, that your early 2020 acquisitions of your single family rentals were maybe $100,000 or $80,000 properties, and now you're in year 4, and because the depreciable basis number is so low to begin with, and you're already in year 4, it may not make so much sense to do it. So that's what we do when we model out the studies. And as you know, we model out any property on our own nickel. It doesn't cost the client anything. And we want to get to a final number to show so that you, the client, and your CPA and your advisors have enough information to make the right decision for you guys.
Thank you for your response on that. Before I go further with the questions I have about 1031 exchange and catch up, someone from the audience has a question. So I'm going to allow her speak. I don't want to call your name because I don't want to mispronounce it. So I'll just unmute you for you to talk. Hi, can you go ahead and ask your question?
Hello, Bibi.
Hi.
Hi. And the guest name again?
Eli,
Hi, Eli. How you
how are
doing
you?
today?
Great.
All right. I'm learning a lot. Thank you. So I did attend cost segregation video presentation in the past. And am I understanding that it's depreciation of when you purchase the property to when you sell, or the benefit, the profits in between?
I just want to make sure I understand your question. You're asking how long the depreciation benefit lasts on the property?
I was asking if cost segregation was the difference of when you purchase the property in depreciation to when you are selling or prepared.
I think she's talking about catch up, because the communication out there is when you're selling, the issue might be the catch up. So she's saying the benefit, is it between when you buy the property and when you sell, in between? Is that when the benefit is, or you still have benefit afterwards and all that? Cherry, am I correct with the way I rephrased your question?
The cost segregation is a benefit,
Right.
is rather than a
What we're doing is we're accelerating the depreciation, which is going to come on your current income tax return and lower your taxable income. So you can do it in year one of the acquisition or the construction, right? And you'll be able to get whatever benefits we get by accelerating those amounts, those assets. Or you can do it in year two, year three, year four, depending on, maybe your CPA feels like your initial year of owning the building, you don't have enough taxable income, or maybe you're carrying a net operating loss and you want to carry it forward. So those are part of what the things that we look at when we determine whether it makes sense for you to do a cost segregation, let's say in the initial year of acquisition, or whether it makes sense maybe a year or two down the road when you have more profits and more taxable income that you can offset and use the deductions from the cost segregation. Does that make sense?
Yes, it does. Okay. So you're essentially calculating your depreciating value.
Correct. And what we're doing is we're really trying to give an income tax projection that will be helpful for you and for your CPA, because you guys sit together at the end of the year and you try to figure out how much income taxes you owe, right? So it's helpful if you knew that by doing one cost segregation, 2, 5, or 10, that you can take your potential tax liability of $1 million, let's say, and wipe it off completely. That's a very valuable tool for you. So what we're doing is working with you and with your CPA to make sure that you have enough information possible to determine how many cost segregation studies you need. Maybe you don't need all of them. Do you need them for this year? Should we wait into a subsequent year? Again, we could do it as a retro study with the 3115 filing. These are all of the things that we get involved with our clients and the CPAs to make sure that we get to the best possible outcome for each client.
Excellent. Thank you.
Thank you, Cherry, for your question. There's a very, very important question that we always hear from our investors. They always want to know at exit what happens, because you've depreciated or accelerated a lot of tax. What happens at exit? For example, if you are not doing a 1031 exchange, if you're not doing, what happens? If you're doing a 1031 exchange, what happens?
So you're asking when you sell the property?
Yes. When you sell the property, what happens? Because you've done cost segregation or you've taken the benefit, and what happens if you're not doing a 1031 exchange and all that? So, yeah.
Sure. So anything that we accelerate today as an ordinary deduction with our cost segregation studies will come back as ordinary income upon sale. So you want to be careful and make sure that your exit strategy in terms of timing, how long you're going to hold the property, to make sure it makes sense to do a cost segregation study. So typically we do studies for clients that own properties anywhere from 2-year to 10-year holds. I try not to do it for a client that feels like they're going to flip the property within a year or so, because like I said, you're going to get an immediate benefit of the deduction, but then you're going to get hit with the immediate ordinary income recapture. And I'd rather not have to do that if I know ahead of time that these are your plans. And I get it. Sometimes you have to make these decisions on the fly. Sometimes a seller comes in with an offer that's too good to be true, and I get all that, then that all makes sense. And we try to do the best that we can. Again, Bibi, as you know, education is the key. Education and communication. If you know what to do and you know who to speak to or the right people to speak to, you'll be able to handle any situation. And yes, to answer your last point, if you were to sell the cost segregation and go into a 1031 exchange, which is another tax deferred vehicle, that's not something that we work on, but it's another tax deferred vehicle. If you do that, then you can avoid any potential income recapture down the road. Again, 1031 has its own rules and regulations regarding certain things of like personal property and potentially recapturing ordinary income. But it's something that you definitely need to speak, not just with the cost segregation professional, but with a competent 1031 exchange specialist to make sure that you don't get caught in a trap of potential ordinary income recapture by going from the cost seg and selling into a 1031 exchange.
Okay, I'm not sure I understood that. Can you break it down a little, a little more for us? Okay, again, I'm not doing a 1031 exchange. I want to sell off my property. The second one is I'm doing a 1031 exchange in the lowest form or the easiest form. What happens?
If you're not doing the exchange, anything we've accelerated as ordinary deductions comes back as ordinary income, and the bulk of the asset is going to be a capital asset, which will be subject to capital gains. Mm-hmm. If you end up exchanging it into a replacement property, then it really depends on what the replacement property is vis-a-vis the relinquished property. So if the relinquished property has, let's say, 10% of accelerated assets, we'll call it 5-year and 15-year property, and your replacement property has 20% of 5 and 15-year assets, then you will not get hit with any ordinary income recapture at all on the exchange. If, however, the other way goes and you trade down, so to speak, and your relinquished property had 20% 5 and 15-year assets and your replacement property had 10%, you will get hit with some form of ordinary recapture on that, because you've traded down and you're going to have smaller amounts of 5 and 15-year property.
Oh, yes. Now I understand. So at the point of exit, who should we be talking to? Is it the cost segregation person like you or our CPA?
Your CPA. The starting point, your starting point is going to be a CPA. If your CPA, if you've done the cost seg and it's just selling it without 1031 exchange, he's going to have all the basis information and all the assets already broken out in your fixed asset software. So it's not going to be a big deal for him to calculate whatever the gain is, the ordinary gain, the capital gain. If it involves a 1031 exchange, the CPA is going to have to figure out the depreciable basis, net of the 1031 deferred gain and all that to figure out. It's obviously a much more complex calculation, but your starting point is going to be your CPA and maybe together with the CPA who handled the 1031 exchange, which is not always going to be your CPA.
Yes, sure. So this is what I always tell our investors. When you're trying to exit, there's a form of communication you need to start having with your partners. And who are they? The CPA, the cost segregation specialist, so that you don't make the wrong decision when you're exiting, so that you're not slammed with capital gains at that point and all that. And I'm happy that you just emphasized on it that conversation should happen with your CPA at the beginning before you try to sell off your property. So my last question, because I know where you are is not comfortable. I see you're sweating. I see the environment is not, so I'm enjoying this conversation. So please permit me for
it's fine
going on and on and on and all that. Audience, if you have any questions, please put them in. My last question, or second to the last question to you, is if I did a cost segregation in year 1 and in year 3, I decided to do a large renovation, do I need to call you back to do a study again, or what just happens? Walk us through that process.
Sure. So the answer is yes, you do need to call us back because the large renovation that you just did is new basis that's going to get booked on the current income tax return that has nothing to do with the original acquisition of the building. And just like we came in and we used our engineers to break out out everything of the property from subgrade all the way up to the roof and all the land improvements. When you do an improvement, whether it's an interior gut reno or whether it's actually building and adding to the footprint and the square footage of the building, you're going to want a competent cost segregation professional who can actually access and break down all the invoices and put them into the different buckets. The 5-year personal property, the 15-year land improvements, the 27.5-year structural, and make sure that you have a proper and comprehensive cost segregation study so that in the unlikely event that the IRS comes knocking, and they do come knocking, I'm not going to lie to you, they do come knocking, that you have enough substantiation to defend the audit. And we, of course, at Madison Specs defend all of our clients' audits and have been successful in defending all of our clients' audits to date in full. So we're quite happy with that.
Yes, this question will lead me to my last question. So, for example, you bought a property, you're supposed to do a 6-month renovation. When do we call you? Is it after the 6 months renovation? Looking at, we're supposed to give K1s to our investors. Let's assume someone closed on a deal in October 2024, and once you close, you have to do a renovation for the next 6 months, which will lead to 2025. When do we do the cost segregation in order to meet up with K1s for the investors? What is the right time? Before or after?
Okay. So you're going to do the initial acquisition of October 2024 for the 2024 return, which means we can do it from the day you close in October 24 all the way up to your filing of the tax return, which would either be, the earliest would be March 15, 2025, or if you go on extension to September 15th. So we can do the study all the way down to September, which we're almost in right now, and do the study for the initial acquisition of October 2024. 6 months later, so let's say you finished your renovation project and you finished it, we'll call it April 2025, okay? So now, let's say you spent $500,000. Now that renovation project is going to first hit your tax return for you and your investors on your 2025 tax return, which means the earliest tax filing will be March 15th, 2026. Okay, so on a renovation project, when you're substantially completed, which could be 95%, that's when you reach out to us, and then we'll get the AIA documents, the blueprints, the invoices, the change orders, and analyze those costs, which will be booked onto the current return, which in your case would be 2025 for the 2025 filing, which will occur in 2026. Is that clear?
Yes, it is.
Did you want me to talk about bonus depreciation really quickly? I know we didn't cover that.
Yes, please talk about it. Yes.
Okay, so in the Trump Tax Act of 2017, they came out with bonus depreciation, which meant the following. Any maker's assets with a class life of 20 years or less. So in our case, we're talking about the 15-year land improvement that surround the building and the 5-year tangible personal property inside the building. Any of those assets were eligible to be depreciated in its entirety. Okay, so it means 100% bonus depreciation. So if we've accelerated $1 million of 5 and 15-year property, you got to deduct $1 million year one. That ran from 2017, from September 2017 through December 31st, 2022. Effective January 1, 2023, that 100% number ratcheted down to 80%. So in the current year of 2023, for those that are still on extension for the 2023 returns, you got to take 80%. So if we've accelerated $1 million of 5 and 15-year property, then you got to take an $800,000 deduction for 2023, and the remaining 20% you would get over that 4/14-year period going forward. Okay, for 2024, for properties bought, built, or renovated beginning 1/1/2024 in our current tax year, it's ratcheted down to 60%. Okay, and then for 2025, it's going to go to 40% and 20%. Currently, there was a bill that was put in front of the Congress to reinstate bonus depreciation at 100%. It was passed by the Senate and it stalled in the House. And at this point, it did not pass. It did not pass by a few votes. So I think we're not going to hear any more about the reinstatement of bonus depreciation until we see who ends up in the White House. And depending on who ends up in the White House, we will either see the reinstatement or we may see some change or some form of change to it.
Yeah, I just wanted to ask you that question now, the update on that. And I think you just broke my heart right now. So, because we're really, really expectant of getting it back to 100% bonus depreciation. But right now, so let's see how it goes and see how it's going to be handled in the forthcoming year and all that. Hopefully, we get it back to 100%. Yes. So why should people work with Madison Spec? What is outstanding about you guys? After that, I want you to talk about what people should take home. What is your keynote to everyone?
Great question. I think here at Madison Specs, we have an amazing team, all accountants, engineers with anywhere from 10 to 25 years of experience, depending on who's working on what. We're very, very focused. We're very passionate about what we do, and we're very professional. We have the expertise to get the maximum depreciation benefit, but also we know that our clients like to sleep well at night. So we're not going to be over aggressive on your backs where that could potentially penalize you down the road. Now, as I said, we've gone through, I think to date, a little over 100 IRS audits of our studies, and all of them were accepted, were issued a 100% no change letter from the service, which meant that they accepted our work in full. Now, what does that mean? Now, there was something called the IRS Audit Techniques Guide, which came out back in 2003, which was a guide by the IRS saying, hey guys, we know you're doing cost segregation studies. We don't have a problem with it. Just make sure whoever's doing it follows the processes and methodologies that we've outlined in this 260-page document. So obviously, all of our studies follow the techniques and the processes of the Audit Techniques Guide. But that being said, there are some subtle nuances and differences based on case law and certain IRS pronouncements that have come down the pike over the past couple of years. And I think that the key is that besides our focus being always on our clients, their number one priority, make sure they're informed, make sure they're educated, make sure they know everything they need to know, and make sure we're proactively communicating with them on a regular basis. I always tell my clients, BB, call me early and often, but call me early, not just often. Call me early. If you're not sure of something, don't wait till after the closing. Maybe I can give you some good advice. Let's say you're building a property and you're building an office property, and you say, hey, Eli, you know what? I'm doing an interior office. What material should I use? Well, okay, that's a good question. Do you want to use drywall? Drywall partitions for the office spaces is going to be a structural item that would get 30/90 depreciation. Do you want to use what's called flex demountable partitions, which cost more, but those flex demountable partitions are considered personal property that are 5-year depreciation, which in our case would be eligible for bonus depreciation. So if you touch base early and on with us, we can give you the best answers upfront, which will help you make a better decision for you overall.
Thank you so much. We are going to reach out to you because we've made some massive renovations on the properties you guys have done cost segregation on. And currently we are under contract on another one, and it's going to have some significant CapEx repairs. So we're going to reach out to you to find out what advice you have for us before we close, just like you stated. So look out for my call. Yes, we'll definitely discuss this. Thank you so much for taking out the time. I know we just had to chime in into your trip because you're on holidays, and we decided to take 1 hour of your time for this. We really, really appreciate your time, and I'm sure the audience actually did, because there were some burning questions I really wanted to ask, but I'm sure I didn't have the opportunity to ask direct questions like this, and I'm sure Cherry also was able to get answers to our questions, and every other person. Right now, it's streaming live on Facebook as we speak. After now, it's going to be shared around other platforms. So other people can go back and rewatch and all that. If you are not subscribed to our social media platform, where we have all content on multifamily, then you are missing a lot. We have lots of content in our YouTube from the beginning A to Z of multifamily. If you're trying to figure out how to navigate that, you can get your answers from our videos on everything on multifamily. If you also need help, people to contact, you can go back to the replays and look at their contact address address in the description button and reach out to them. I look forward to seeing you guys in our next event. Next event, we'll be having a loan broker. This is a very good friend of mine. He's been helping me on my entire deal. The thing about Blue Ocean is once we create a relationship with you, it's for life, except you break it. When we use services and they're good, we just remain with them. It's very difficult for us to move. So I've been using this loan broker for a while, and he's been magnificent. So he will be telling us everything that has to do with loan and what the implication of the reduction in interest rates is going. We're going to be discussing that effectively next Wednesday, not this coming Wednesday, upper Wednesday, because we hold this every other Wednesdays. I look forward to seeing you all in our next event. How can they reach you or any member of your team? You can just say it out, then we'll also do that as well.
So you can reach me at the end of my slide. If you share with people, you'll have all my contact information. You can reach me at eli.lobenberg@madisonspecs.com, and you can share that with your audience as well. Be happy to speak with anybody.
We'll be sending out a thank you email for everyone that registered, and you'll be getting the slide. We're supposed to use slides today, but we decided not to. So with that slide, you'll be able to get their contact. You can also book a call. We'll get their information how they can book a call with you, and we'll add that to the emails that we're sending out to every one of you. Yes, they will all have it. I can assure you that. Thank you all once again, and have
Thank you so much.
Thank you.